viewers at home, you are welcome to my presentations on IAS 8. IAS 8, Accounting Policies, Changes in Accounting Estimates and Errors. In this presentation, I will be explaining the meaning of accounting policies, the accounting estimates and errors. Then I will equally explain how to identify when there are changes in accounting policies and changes in accounting estimates in examination questions. Then I will equally solve 4 different work examples from the past examination questions and from Kaplan and BPP ACCA study test. I would like to appreciate you for the encouragement I have received from you from my past presentations. There are principles in accounting, or basis, or conventions, or rules, or practice which accountant normally apply in preparing and presenting their financial statements. That principle is known as accounting policies. Therefore, accounting policies are the specific principles, basis, conventions, rules, and practices applied by an entity in preparing and presenting financial statements. Accounting policies are the specific principles, basis, conventions, rules, and practices applied by an entity in preparing and presenting financial statements. Accounting policies are the specific principles, basis, conventions, rules, and practices applied by an entity in preparing financial statements. So, examples of accounting policies. Examples of accounting policies. Number 1, we have the method of valuing inventories. Examples of accounting policies. We have the methods of valuing inventories, whether FIFO or weighted average. Methods of valuing inventories, whether FIFO, first in first out method, or weighted average method. In accordance with IAS 2. Number 2, we have method of valuing property, plant, and equipment. Method of valuing property, plant, and equipment, whether cost model or evaluation model. Whether cost model or revaluation model. These are the examples of accounting policies. I said accounting policies. I said they are the specific principles, basis, conventions, rules and practices applied by an entity in preparing and presenting financial statements. That is accounting policy. I've given you examples of accounting policy. I made mention of methods of valuing inventory, whether the FIFO method or weighted average method. Then the method of valuing property, plant and equipment, whether cost model or the evaluation model. Then the next one is consistent applications of accounting policy, policies. In accordance with IAS 8, number 8, once a policy has been chosen, that policy must be applied consistently from period to period. In accordance with IAS 8, once an entity has chosen its policy, the policy chosen by the entity must be applied consistently from period to period. Frequent changes in policies are not permitted. Frequent changes are not permitted unless it is allowed or permitted in IFRS. So, changes in accounting policy. Changes in accounting policies. Changes in accounting policies. Accounting policies. I want to explain or discuss the circumstances where the entity can change their policy. Number one, where the changes is required by the IFRS or standards, where the changes is required by IFRS or standards, then the entity can change their policies. Where the IFRS requires the entity to change that policy, or where IFRS automatically change the policies of the entity, such policy may change. 2, where changes in policy will result in better presentations of financial statements. Where changes in policy will result in better presentations of financial statements. Where the changes will result in a better presentations of financial statements, the entity can change their policy. Then we have selection of accounting policies. Selection of accounting policies. Selection of accounting policies. Selection of accounting policies. An entity should follow the accounting standards when deciding its accounting policies. An entity is expected to make use of the accounting standard whenever they are selecting their accounting policy. Whenever an entity is selecting their accounting policy, the entity should follow the use of the accounting standards such as IFRS or the laws. Number 2, management should use the most relevant and reliable policy if there is no guidance in the standard. Management should use the most relevant and reliable policy if there is no guidance in the standards. So it is where there are no guidance in the standard, management should use the relevant accounting policies. Then identifications of accounting policies. Identifications of accounting policies, of identification of changes in accounting policies, of changes in accounting policies. There are three principles I'm going to explain here as regards this. So, identifications of changes in accounting policy. A change in accounting policies occurs if there has been a change in these three things I'm going to explain. A change in accounting policies occur if there are changes in number one, recognition, number two, measurement, number three, we have presentations. If there are changes in any of these three, it is then that you can say there are changes in accounting policies. If any of these three doesn't change, that means there are no changes in accounting policy. Before you can say there are changes in accounting policy, then one of these three things, or at least one of these three things, must have changed. Number one, recognition. What do you mean by recognition? Recognition is the process of incorporating into the financial statements those items that meet the definition of an element and the recognition criteria. So when you incorporate into the financial statements those items that meet the definition of an element and the recognition criteria, then that is what we mean by recognition. So now, recognitions. So if an item that have been previously been recognized as an expense is now recognized as an asset, then you can see there is a change in policy. Expense is now recognized rather than an asset. Expense is now recognized rather than an asset. That is recognition. Something that should be recognized as an expense, that thing is now recognized as an asset. Then that means the policy has changed. In accordance with the revised IAS 23 borrowing cost, before this IAS 23 was revised, all borrowing costs we usually charge them as an expenses. Before the revised IAS 23, we used to expense all borrowing costs. But now, with the current requirement of IAS 23, the revised one, the borrowing cost that is attributable to the acquisition, the borrowing cost incurred in connection with the acquisition, construction or production of qualifying assets should be capitalized. Meaning that the borrowing cost we used to charge as an expenses now, the requirement is that they should be charged as an asset. That means the recognition criteria has changed. Where an item that have been previously been recognized as an expense is now to be recognized as an asset, or something that should be recognized as an asset now recognized as a liability, then that means the recognition criteria of that item has changed. That is recognition. The second one is measurement. Measurement means the determination of monetary amount at which an element can be recognized. Measuring non-current asset at cost rather than variation. Example, we have the cost model and the revaluation model of measuring the non-current asset. Measuring non-current assets at cost rather than at valuation. Where an entity has previously been recognizing non-current assets at valuation, and the standard now required that asset should be recognized at cost, that means the policy has changed. The asset they normally recognize at valuation before, they now want to change from valuation to the cost. Then when they change from valuation to cost, that means their policy has changed. That is measurement. Measuring non-current assets at cost rather than at valuation. The third item is presentation. How the items will be presented in the financial statement. Where the depreciation, they normally charge depreciation, where an entity normally charge depreciation as an administrative expenses before. Instead of charging that depreciation as an administrative expenses, they now want to charge it as cost of sales. Where an entity will now charge depreciation to cost of sales rather than administrative expenses, that means the policy of the entity has changed. Depreciation is now included in cost of sales rather than administrative expenses. Depreciation is now included in cost of sales rather than administrative expenses. The entity has previously used to charge depreciation to administrative expenses, but now they now want to be charging it to cost of sales. That means their policy has changed. That is presentation. Their presentation, the way they used to present that item has changed. That is what we mean by presentation. Accounting for changes in accounting policies. Accounting for changes in accounting policies. Accounting for changes in accounting policies. How do you account for it? How do you record a change in accounting policies? In accordance with IAS 8, a change in accounting policies should be applied retrospectively. A change in accounting policy should be applied retrospectively. That is the requirement in IAS 8. In accordance with IAS 8, a change in accounting policies should be applied retrospectively, and adjustments must be made in the opening retained earnings. Adjustment of it will make it in the opening retained earnings. We say it should be applied retrospectively with adjustment in opening balance of retained earnings in the statement of changes in equity. Changes in accounting policy should be applied retrospectively with adjustment in the opening balance of retained earnings in the statement of changes in equity. That is how to account for that. What do you mean by retrospective application? Retrospective applications is the application of a new accounting policy to the transactions occurring before, as if that policy had already been applied. The application of a new accounting policy to the transactions occurring before, as if that policy had always been applied. That is retrospective application. This is the application of a new accounting policies, a new accounting policy to the transactions occurring before as if that policy had always been applied. What do we mean by that? Take for instance, the entity have always charged all borrowing costs. The entity have always expensed all borrowing costs. Borrowing costs mean interest. The entity have always charged all interest to expenses. Maybe in year 1, they have expensed their interest. In year 2, they have expensed all their interest. Maybe we have year 1, year 2, year 3. They have charged the interest of $100,000 as an expenses. Out of this interest, there are a portion of the interest that relates to acquisition of an asset. The portion of interest that relates to acquisition of asset is 60,000. In year 2, interest expense is 80,000, out of which 50,000 relates to the acquisition of an asset. But in year 3, they now want to follow the requirement in IAS 23, borrowing costs. We says that the interest that relates to the acquisition, construction, or production of qualifying assets should be capitalized. So remember, this amount have been charged as an expenses. It is part of this that we have this 60,000 that relates to the acquisition, meaning that all the 100,000 was expensed, all the 80,000 was expensed, out of which 50,000 relates to the acquisition. But you now want to follow the requirement in IAS 23. In IAS 23, in year 3, they have incurred borrowing costs of 120,000, out of which 70,000 relates to the acquisition of an asset. That means the amount of this borrowing cost they will charge as an expenses is 50,000. 70,000 will be capitalized. That is, they are going to record the remaining 70,000 as the cost of the asset. So, if that should be done, or if that will happen, the standard requires that they should go back to year 1 and continue capitalizing. They should capitalize this 60,000. They should capitalize 50,000. Then in year 1, then they will now look at the effect of that with what they have done before. You know, the whole 100,000 was expensed before. They want to compare the effect now. When you charge 100,000 as an expenses, that means profit will reduce. Compare with when you now capitalize 60,000. So that means what you have expensed now is 40. What you have expensed is 40,000. Then the 60,000 now, which you have now capitalized in year 1. We have tax consequence. You consider the tax consequence and the effect of that 60,000 on your profit. Then you pretend, that is, you go back to year 1 and continue to capitalize the 60,000. And the effect of it now will now be adjusted in your retained earnings. That is what we mean by retrospective application. Retrospective application. That this new policy now, the new policy is to capitalize the borrowing costs relating to acquisition. That you want to start capitalizing from year 3. What the standard is telling you is that you should go back to year 1 and continue to capitalize it as if you have been capitalizing that borrowing cost from year 1. It's not just that you will start from year 3 and continue to capitalize and forget what you have done in the previous years or periods. So the standard requires that IAS 8 by retrospective applications that you should apply this new policy of capitalizing borrowing costs relating to acquisition of an asset from the beginning, from the previous years, from the year 1, from the inception of that transactions. And see, that is the way you have been doing it. That is retrospective application. By retrospective application, we mean the application of a new accounting policy to the transactions occurring before, as if that policy had always been applied. That is, a change in accounting policy should be applied retrospectively. A change in accounting policy should be applied retrospectively with adjustment to opening balance of retained earnings in the statement of changes in equity. That is, changes in accounting policy. Now, accounting estimates. Accounting estimates. You should not confuse the accounting estimates with the accounting policy. Accounting estimates. Accounting estimates. Accounting estimates is a method adopted by an entity to arrive at estimated amount for the financial statement. The method adopted by the entity. The methods adopted by an entity to arrive at the estimated amounts for the financial statement. That is accounting estimate. The method adopted by an entity to arrive at the estimated amounts for the financial statements. You know, accounting estimate arises because we don't have a precise basis of measurement. We don't have the precise basis of measurement. So examples of accounting estimates. Number one example is allowances for receivables. Allowances for receivables. That is your provision for bad or doubtful debts. Allowances for receivables. Then obsolescence of inventories. Obsolescence of inventories. Obsolescence of inventories. Then we have change in useful economic life of property, plant, and equipment. You have change in useful economic life of property, plant, and equipment. These are estimates. No, anytime there are changes in method of estimation, then that means there are changes in accounting estimates. If there are changes in estimation technique, that means there are changes in accounting estimates. In accounting, we have the different method of estimation techniques. Estimation technique. I've told you that where there are changes in estimation technique, that means there are changes in accounting estimate. The estimation technique we have in accounting, the commonest one, we have the provision for bad or doubtful debts. Provision for bad or doubtful debts. For bad or doubtful debts. Doubtful debts is an estimation technique. Then we also have the provision for depreciation. It's an estimation technique. No, since we have different methods of calculating depreciation, you want to calculate the depreciation, you want to estimate the amount of depreciation to be included in the financial statement. Provision for depreciation is an estimation technique. Then provisions in accordance with IAS 37. IAS 37 is an estimation technique. Anytime there are changes in estimation technique, that is a change in accounting estimates. Examples of changes in accounting estimates. Examples of changes in accounting estimates. Number one, change in the useful life of PPE. Change in the useful life of property, plant, and equipment. Change in the useful life of property, plant, and equipment. Change in the residual value of property, plant, and equipment. Change in the residual value of the property, plant and equipment. That is the change in accounting estimate. Change in the method of depreciation. Change in the method of depreciation. That is a change in accounting estimate. Because it's an estimation technique. Number 4, we have warranty provisions. Warranty provisions, that is IAS 37. Warranty provisions based upon more up-to-date information. More up-to-date information. More up-to-date information about claims frequency. About claims frequency. That is a change in accounting estimate. Change in accounting estimate. So, in accordance with IAS 8, a change in accounting estimate should be applied prospectively. A change in accounting estimate should be applied prospectively. Remember, change in accounting estimate should be applied retrospectively. Why a change in accounting estimate should be applied prospectively? What do you mean by prospective application? Prospective application. Applications. What do you mean by that? Remember, I've told you that a change in accounting estimate should be applied prospectively. Therefore, prospective application, this is the application of a new accounting policy to transactions and events occurring from the period when the policy was made. This is the application. This is the application of a new accounting policy, of a new accounting policy of a new accounting policy to transactions and events. Transactions and events. Events occurring from the period when the policy was made. Events occurring from the period when the policy was made. So, prospective application. This is the application of a new accounting policy to transactions and events occurring from the period when the policy was made. So what do you mean by that? Unlike the change in accounting policy, which we have earlier said that will be applied retrospectively, a change in accounting policy should be applied prospectively. By prospective application, meaning that if year 1, let me say year 1, your depreciation method is straight line. Year 1, you charge depreciation of 10,000. In year 2, 10,000. In year 3, you now want to change to reducing balance method. Reducing balance method. Since a change in method of depreciation is a change in accounting estimates, that means it is the amount that will be affected, not the method. Not the policy. The amount will be affected. The estimated amount is what will be affected. So it is not as a result of the recognition changes or measurement changes or presentation changes. So since it is the method, that is the estimated amount that will be affected, then you deal with it prospectively. That means from year 3 now that you have changed to reducing balance method, your depreciation may be 8,000. So just continue applying your reducing balance method. You don't need to go back to year 1. Unlike changing policy where you have to go back to the first year of that item. So that is change in accounting estimate. Then the third one is prior period errors. Prior period errors. Prior period errors. Prior period errors are omissions from and misstatements in the financial statements for one or more prior periods. Omission from and misstatements in the financial statements for one or more prior periods. Prior period errors are omissions from and misstatements in the financial statements for one or more prior periods. To correct the accounting for prior period error. Accounting for prior period error. This will also be corrected retrospectively, just like a change in accounting policy. The same way you treat a change in accounting policy is also the way you will also deal with a change, the correction of prior period errors. The way you deal with the changes in accounting policy is the way you will equally deal with the correction of prior period errors. It's only a change in accounting estimate that should be dealt with prospectively. Why accounting policies and prior period errors should be dealt with retrospectively. That is for that. So we want to take a question. We are going to solve 4 different questions as work example to explain this. Example 1. Which of the following is a change in accounting policy as opposed to a change in estimation technique? Which of the following is a change in accounting policy as opposed to a change in estimation technique? Number 1, an entity has previously charged interest incurred in connection with the construction of tangible non-current assets to the statement of profit or loss. Following the revision of IAS 23 and in accordance with the revised requirement of that standard, it now capitalizes this interest. Now, the entity have previously used to charge the interest incurred in connection with the construction of tangible non-current assets to the statement of profit or loss. That was the former treatment. But following the revised IAS 23, the entity now want to capitalize it. That is, by capitalizing it, it means the entity want to charge it as an asset. So now, is this a change in accounting policy or a change in accounting estimate? Now, if you look at this question, 2 things are, the first thing, I've told you that there are 3 things to use in identifying whether there are change in accounting policy or not. The first one is recognition. The second one is measurement. The third one is presentation. Now, this you have previously used to charge it as an interest in the statement of profit or loss. You now want to capitalize it as part of the asset. That means your recognition criteria will change, because instead of you charging it as an expenses, you now want to have it as an asset. That means recognition criteria has changed. Number 2, another thing that equally changed is the presentation. This item would have been presented as an expenses in the statement of profit or loss, but now it will be presented as an asset. 2 things have changed. Number 1, recognition. Instead of having it as an expenses, You will now be having it as an asset. That means the recognition criteria has changed. Then the presentation too has changed. Instead of having it as an expenses in the statement of profit or loss, you will now be having it as an asset. It will no longer be recognized as an expenses, but will be recognized as an asset. That means recognition has changed and presentation has changed. Therefore, a change in recognition, this is a change in recognition and presentation. And I've told you that a change in recognition and a change in presentation is a change in accounting policy. Change in recognition. Number one is a change solution. Number one is a change in recognition. This is a change. This is a change in recognition. Change in recognition. Change in recognition and presentation. Since this is a change in recognition and presentation, therefore it is a change in accounting policy. It is a change in accounting policies. Accounting policy. It is a change in accounting policy because it is a change in recognition and presentation. Number two, an entity has previously depreciated vehicles using the reducing balance method. The entity has been using reducing balance method at 40% per annum. It now uses the straight line method over a period of 5 years. The entity has been using the reducing balance method, but the entity now wants to use a straight line method of depreciation. Remember, recognition, you confirm if recognition has changed. Recognition hasn't changed because it will still be recognized as it will still remain as an expenses. Depreciation will still be an expenses. So recognition hasn't changed. Then measurement hasn't changed. Presentation hasn't changed. So since it hasn't resulted in a change in any of those three items, therefore it is not a change in accounting policy. The only thing that has changed is the change in estimation technique. The method of estimating it is what has only changed. This is a change in estimation technique. This is a change in estimation technique. It is the technique, that is the method of estimation, that has changed. Recognition hasn't changed, measurement hasn't changed, and presentation hasn't changed. The only thing that has changed is the technique of estimation. You want to estimate the amount of depreciation to be included in the financial statement. That is only what you want to do, and your recognition will still be the same. Since none of those three items have changed, therefore this is a change. This is a change in accounting estimates. This is a change in accounting estimates. The third item, the third one, number 3, an entity has previously shown certain overheads within cost of sales. They used to charge those overheads as cost of sales. It now shows those overheads within administrative expenses. Instead of charging them as cost of sales, they will now be charging them as administrative expenses. This is a change in presentation. This is a change in presentation. And I've told you that 3 things you have to consider is: number 1, recognition; number 2, measurement; number 3, presentation. Since the way this item will be presented has changed, You will no longer be presenting it as cost of sales. You will not be presenting it as administrative expenses. That means the presentation method has changed. Therefore, this is a change in accounting policy. This is a change in accounting policy. It is a change in accounting policy because it is a change in presentation. Number four, an entity has previously measured inventory at weighted average cost. You have previously used to measure your inventory at weighted average cost. It now measures the inventory using the first in first out method. Measured inventories. You used to measure your inventory at weighted average, but you now want to use FIFO method. This is a change in measurement basis. This is a change in measurement basis. Now, I've told you that for you to know whether there are changes in policy, you have to check out three things. Number one, recognition. Number two, measurement. Number three, presentation. Since this is a change in measurement basis, therefore, it is a change in accounting policy. It is a change in accounting policy. Change in accounting policy. So, that is all about that. That is all about example one. So, I want to take the second work example. So, this first example was obtained from ACCA study test by Kaplan. The first example, the question I've just solved, was obtained from the ACCA study test by Kaplan. Example 2. ACCA Limited's accounting policy is to recognize assets at no more than their recoverable amounts. Consistent with this, and based upon experience, it has always provided in full against trade receivables which have been outstanding for 6 months or more. Because the economy is entering a period of recession, it has reconsidered the recoverability of its receivables and decides to provide in full for amounts outstanding for 3 months or more required. This is a change in accounting policy or estimates. So you assess if any of recognition, measurement, and presentation has changed. So if you assess this, accounting policy is to recognize assets at no more than their recoverable amounts. Consistent with this, and based upon experience, it has provided in full, that is provision, it has provided in full trade receivable which have been outstanding for 6 months or more. Because the economy is entering a period of recession, it has reconsidered the recoverability of its receivables and decides to provide in full amounts outstanding for 3 months or more. So this is a change in estimation technique. So you want to vary your provision. So this is a provision. So it's a change in estimation technique. So this is a change in estimation technique. This is a change in estimation technique. So a change in estimation technique, therefore it is a change. It is a change in accounting estimate. A change in accounting estimate. So So it is a change in accounting estimate. That is the solution to example 2. Example 3. During 20X1, a company discovered that certain items had been included in inventory at 31st December 20X0 at a value of $2.5 million, but they had in fact been sold before the year end. The original figures reported for the year ending 31 December 20X0 and the figures for the current year 20X1 are given below. You are given 20X1 and 20X0 respectively. Everything in thousand. We have sales 52,100 and 48,300. Cost of sales 33,500 and 30,200. Gross profit of 18,600 and 18,100. Tax of 4,600 and 4,300. We have net profit of 14,000 and 13,800 respectively. The cost of goods sold in 20X1 includes the 2.5 million error in opening inventory. The retained earnings at 1st January 20X0 were $11.2 million. Assume that the adjustment will have no effect on the tax charge. Show the 20X1 statement of profit or loss with comparative figures and retained earnings. For each year, disclosure of other comprehensive income is not required. Disclosure of other comprehensive income is not required. So that is the question. So solution. So now you were told that during 20X1, a company discovered that certain items had been included in inventory at 31st December 20X0 at a value of 2.5 million. That item had been included at the value of 2.5 million, but they had in fact been sold before the year end. The original figures reported for the year ending 31st December 20X0 and the figures for the current year 20X1 are given below. You are given the financial statement, the statement of profit or loss. The cost of goods sold in 20X1 include 2.5 million error in opening inventory. The cost of goods sold, this cost of goods sold, include that errors in the opening inventory. So if there are errors in opening inventory of 2.5 million, which has been included in cost of sales, that means the value of cost of sales have been overstated because the error has been included in that. The cost of sales has been overstated due to errors which have been included in the cost of sales. Now, you are equally given the retained earnings at 1st of January 20X0 were 11.2 million. Assume that the adjustment will have no effect on the tax charge. Now, there is opening inventory errors of 2.5 million, which has been included in this opening inventory. That means in 20X0, it will have been the closing inventory here. That means you will need to adjust your cost of sales for that errors, prior year error. Know what is opening inventory in 20X1 will have been the closing inventory in 20X0. And we used to less closing inventory from goods available for sales to get cost of sales. That means if your closing inventory have been deducted and the amount deducted as closing inventory is overstated, that means the cost of sales for 20X0 will have been understated. So since the cost of sales have been understated, so to correct that prior year error, you add it to cost of sales in 20X0. But the 20X1, the closing inventory in 20X0 was an opening inventory in 20X1. The opening inventory now, increase in opening inventory will make the cost of sales to be very high. That means the cost of sales in 20S1 have been overstated. In order to correct that, so you deduct the prior year error. This is an error. So now, cost of sales adjustment now. Cost of sales adjustment. So we want to make some adjustment in cost of sales. You have 20S0 and 20X1. 20X1. So we have cost of sales as per the financial statement, cost of sales as per the statement of profit or loss. Cost of sales as per statement of profit or loss in 20S1 is 33,500. 33,500. In 20S0 it was 30,200. 30,200. So we now adjustment for prior year error. Adjustment for prior year error. We said that amount was included in opening inventory for 20S1. Cost of sales in 20S1 include 2.5 million error in opening inventory. Since it was included in opening inventory, an increase in opening inventory will make cost of sales to be very high. That means the cost of sales have equally been overstated. Therefore, since it has been overstated, you are going to less the error. You deduct that error. Then, for 20S0, it was closing inventory in 20S0. And the closing inventory for 20S0 will make the cost of sales to be very low. Because we used to less closing inventory from goods available for sales. That means the cost of sales have been reduced. In order to correct it now, you add the error in inventory. So that is cost of sales adjustment. So 33,500 minus 2,500. Then that will give us 33,500 minus 2,500. That will give us 31,000. 31,000. That is cost of sales adjustment in 20X1. Then for 20X0, if you add this, you have 32,700. That is the cost of sales adjustment. So you now prepare the revised income statement now. Revised income statement or revised statement of profit or loss. That is for the company. You have for 20X0, the 20X0 is the comparative year, then with the financial year is 20X1. So the first item is sales. Sales. We have sales of 52,100 in 20X1 and 48,300 in 20X0. Sales of 52,100 and 48,300. From sales, we less cost of sales. The revised one, which is 31,000 for 20S0, and for 20S1. For 20S0, we have 32,700. That is the revised one. When you less cost of sales from sales, you arrive at the gross profit. Gross profit. So when you subtract 52,100, 31,000 from 52,100, we have the gross profit of 21,100. Then for 20S0, we have 48,300 minus 48,300 minus 32,700. Then you have the gross profit of 15,600. That is the gross profit. Then after gross profit, you have tax. Tax. Remember, you have been told that assume that the adjustment will have no effect on the tax charge. That means you are going to avoid or eliminate tax consequence of the error. So you don't need to consider the tax. you don't need to consider the tax. So we have 4,600 as the tax. You don't need to consider the tax on the error. So you have 4,600 as the tax for the current year, and 4,300 respectively. 4,600 and 4,300. I've told you that you don't need to consider the tax on the error, the tax consequence or on the error or of the error. So now when you subtract 4,300 from 15,600, then you have 11,300. Then 21,100 minus 4,600, then you have 16,500. That is the net profit. That is the net profit. That is the adjusted net profit. Then the next thing is retained earnings. Retained earnings. We said the errors. We said prior year errors will be adjusted retrospectively. So you have 20x0 and 20x1. 20x1 and 20x0. Then you have opening balance of retained earnings. Opening balance of retained earnings. And how much is your retained earnings in the opening balance? So you check. You were told that the retained earnings at 1st January 20x0 were 11.2 million. 20x0. The one for 20x0 is 11.2 million. That is the retained earnings. Then, how much will be the retained earnings in 20x1? Just add the profit for that year. 13.8 million. Net profit for 20x0. That will give you the retained earnings for 20x1, since we're not given the dividend. So you have 11.2 million plus 13.8 million. That will give you the retained earnings for 20x1. 11.2 million plus 13.8. That will give us 25 million. And that is the retained earnings for 20x1. Then we also have prior year error. Prior adjustment for prior year error. Adjustment for prior period error. The error we want to adjust is 2.5 million, which is the current year. 2.5 million, we adjust it in the retained earnings. So the restated balance, we have the restated balance, and that will be 22.5 million. Then this will still remain as 11.2 million. Then followed by the profit, net profit for the year. Net profit for the year. Net profit for the year. For 20x1, we have 16.5 million. 16.5 million and 11.3 million. 16.5 million and 11.3 million. So if you after adjusting that, you have closing balance of retained earnings. Closing balance of the retained earnings. So we have 22.5 million plus 16.5 million. There you have 39 million. For 20x1, 39 million. For 20x0, you have 22.5 million. 22.5 million. This question is also obtained from ACCA study test by Kaplan. That is the solution to example 3. Example 4. This question is obtained from ACCA study test by BPP. It is similar to example 3, but with tax consequence. During 20X7, Global discovered that certain items had been included in inventory at 31st December 20X6, valued at 4.2 million. Something had been included in inventory at 31st December 20X6, and that is 31st. That is the end of 20X6. That is closing inventory this time around. No closing inventory will have been deducted from cost of sales, which had in fact been sold before the year end. The following figures for 20X sales as reported and 20X7 drafts are available. You are given the financial statement for 20X6 and 20X7. Note, retained earnings at 1st January 20X6 were 30 million. The cost of goods sold for 20X7 includes the 4.2 million error in opening inventory. That is for the 20X7, the opening inventory of 20X7 contains the errors. No, it will have been reported as closing inventory for 20X6, now opening inventory for 20X7. That error has been included. The income tax rate. The income tax rate was 30% for 20X6 and 20X7. No dividend had been declared or paid. Required. Show the income statement for 20X7 with the 20X6 comparative and retained earnings. So that is the question. So now, just like the example 3, working 1, you are going to have this adjustment in cost of sales. Cost of sales adjustment. Cost of sales adjustment. We have 20X6, 20X6 and 20X7. So we now have balance as per the statement of profit or loss. The cost of sales as per the statement of profit or loss is 34,570 in 20X6. 34,570. And in 20X7 it was 55,800. 55,800. 55,800. Then we have errors in inventory. Retained earnings. We were told retained earnings at 1st of January 2006 were 13 million. The cost of goods sold for 20X7 include the 4.2 million error in opening inventory. Since 20X7, inventory contain error in opening inventory. That means the cost of sales, opening inventory, you know, we used to say cost of sales, opening inventory add purchases. So since opening inventory will be added to purchases, that means your cost of sales for 20X7 will have been overstated. So since it is overstated, we are going to subtract that errors, inventory error, from cost of sales for 20X7. Then what have been reported as closing inventory for 20X7 will be the opening inventory for 20X6. Will be the closing inventory. The opening inventory for 20X7 will be the closing inventory for 20X6. You know, we used to less closing inventory from goods available for sales to get cost of sales. And the closing inventory for 20X6, the closing inventory for 20X6 has been overstated. The closing inventory for 20X6 has been overstated. That means the amount subtracted from goods available for sales to get cost of sales is overstated. Therefore, cost of sales will have been understated. So if this is understated, then you are going to add the error in inventory. So inventory, let me say stock adjustment or inventory errors. So, and how much is the value? Includes the 4.2 million error in opening inventory. 4.2 million. The amount of the error is 4.2 million. So that means the 4.2 million, since it is closing inventory here, which has led to, in 20X7, it is closing inventory, which has led to reduction in cost of sales. So we are adding it in 20X6. In 20X7, it is opening inventory overstated. Therefore, you are going to subtract it. You subtract the inventory errors or adjustments. So we have 34,570 for 20 axis plus 4,200, and that will give us 38,770. Then for 20 axis S7, for 20 S7 we have 55,800 minus 4,200, and that will give us 51,600. Then we prepare the revised income statement. Revised income statement, that is for global. Global, we have revised income statement for the year ended, for the period ended 31st December. We have 20x6 and 20x7. The first item is sales, and the sales figure will still be the same. The sales will be the same. The sales will be the same, and the sales is 47,400 and 67,200 for 20x6 and 20x7 respectively. Then from sales we less cost of sales. Cost of sales, that is from working one. Working one, the cost of sales is 38,770. 38,770, and that of 20x7 is 51,600. So when you less cost of sales, then you get the gross profit. You get the gross profit. You get the gross profit. So our gross profit now for 20x6 you have 47,400 minus 38,770, and that will give us 8,630. 8,630. For 20x7 you have 67,200. 67,200 minus 51,600, and that will give us 15,600. 15,600. That is gross profit. From the gross profit, you less tax. Gross profit we have. You have profit before tax. Sorry, this ought to be profit before tax in the question. It is profit before tax. Profit before tax. After profit before tax, the next thing should be tax. The amount of tax that will be charged as an expense. The tax expense. So you are going to work it out. Working two, we have tax. So we have 20x7, 20x6. We now have tax as per the financial statement. Tax as per the statement of profit or loss. And that tax is 3,880 for 20x6 and 3,400 for 20x7. 3,400 for 20x7. Now, what is the tax consequence of the errors in inventory? Remember, it is opening inventory in 20x7 that have been overstated. It is inventory in 20x7 that have been the opening inventory that have been overstated in 20x7, leading to overstatement of cost of sales. An overstatement of cost of sales will lead to lower profit. And if the profit before tax reduces as a result of overstatement, as a result of the overstatement of cost of sales, if the profit before tax reduces, then that means the tax will also reduce, because tax will be calculated on the profit before tax. That means the tax that have been charged has been understated. So that means you are going to add the tax on that inventory error. So we now have tax consequence, tax on inventory error or error in inventory, which is 4.2 million times, and we are given tax rate of 30%. Tax rate is given to be 30%. 4.2 million, 30% of 4.2 million. So we calculate that. 4.2 million times 0.3. 30% of 4.2 million. That will give us 1,260. We said tax for, since the profit before tax for 20x7 have been understated, that means the tax that will be charged will be understated. So you are going to add the tax to the 20x7. 1,260. You add it. That is the tax for that period. The tax on inventory error. Then for 20x6, note the closing inventory that have been deducted is too much. That will lead to understatement of cost of sales. That means the cost of sales is lower. And when the cost of sales is understated, then that means profits have been overstated. And when the profit before tax has been overstated, that means the tax that will be charged on that profit too will be overstated. So you are going to subtract the tax on the inventory error from 20x's tax. So you get the amount of tax that will be adjusted, minus 3,880. Then you have 2,620, 2,620. Then for 20x7, 3,400 plus 1,260, and that will give us 4,660. 4,660. Then you now charge that tax. That is the amount of tax you are going to charge for 20x6 and 20x7. So you have tax of 2,620 as calculated, and 4,660 for 20x7, 4,660. So when you deduct that, that is working 2. Then you have the profit for the year. Profit for the year, the one adjusted. So you have minus 15,600. The profit for the year here is 10,940. 10,940. You know the profit for the year, the unadjusted one, the one given in the question is this. Then we have 8,630 minus tax. 8,630 minus tax of 2,620. 2,620, you have 6,010. That is the profit for the year. So then the next thing is the retained earnings. Retained earnings. And you have been given the retained earnings as at 1st of January 20x6. The retained earnings as at 1st of January 20x6 were 30 million. The retained earnings as at 1st of January 20x6 is given to be 13 million. So you have retained earnings. You have 20x6. Then we also have 20x7. 20x7. Balance brought forward. That is the opening balance. The retained earnings for 20x6 is 13 million. Then to get the retained earnings for 20x7, you add the profit for the year of 8,950 to this, to the 13 million. 13 million plus 8,950,000, which is the profit for the year. Then that means you have 21,950. 21,950. So now the next thing is prior year adjustment. Prior year adjustment. You know the error in inventory. Let's have working 3. The error in inventory is 4.2 million. So working 3, prior year adjustment. Error in inventory. Inventory is 4.2 million as given in the question. Then we now have a tax. There is a tax consequence on that of that error, which is 1,260,000. When you calculate 30% of this, 1,260,000. So what is the difference between that? You have 4.2 minus 1,260,000, and that will give us 2,940,000. 2,940,000, and that is the amount that will be charged here. Okay, for 20x7, it will be deducted from the opening inventory 2,940. So when you deduct the 2,940 from 21,950, you have the restated balance to be 19,010. That is the restated balance. So the restated balance is 13 million here, and this one is 19,010,000. Then after that, you have the profit for the year, the one adjusted, that is the adjusted profit for the year. Profit for the year, and that is 20x6, 6,010. 20x7, 10,940. There is no dividend declared or paid. So if you sum up this now, you have 19,010,000, and this one will be 29,950,000. That is the solution to example 4. Please subscribe to the channel so that you will continue to receive notification each time I drop another video.